Hey everybody, welcome back. A lot to cover. We have earnings again this evening. We have to go through that. We have to go through what's happening and what we're expecting to happen on Friday and what you can expect tomorrow. So this is going to be packed. There's going to be a lot in here. Let's start. S&P 500 breaks down. We had our level. It went through it like Swiss cheese. If we just zoom out for a second and look at our levels right here, you can see how we broke, and then from there it was just on and it was constant all day. We actually went through these levels earlier this morning in the pre-market live that we do publicly every day, and I just want to show you something that was pretty obvious. We're going to zoom in on this hourly right here, and then once you broke, I'm going to leave that level right there. But once you got there, that was pretty much it. And you can see it was on like Donkey Kong. And then all of a sudden, you're just into the gap. So there's some big levels here. But here's the good news. You really filled the gap. And you like to fill these. It makes you feel good, right? Everyone feels better when these gaps are just filled and they're done. All right. And straight down's not a pattern, but it was for today. And there's a couple of reasons for that. We've been talking about the hyperscalers. If you don't know what a hyperscaler is, congratulations, you will by the end of this video. And you want to pay attention to them. They're the names that are actually getting destroyed today, and there's a reason why for that. But straight down is not a pattern. Will we see a bounce? What I always like to do before we even go any further is you just take a step back, look at RSI and go, where are we in the food chain? Now, why do I use RSI? I use RSI because institution investors, they use RSI. If you ever look at any institutional research or any buy side kind of guy, they're always looking at RSI and where you are. Not so much to act, but they just want to understand where they are in the pecking order. For example, if you're oversold here and you're still dropping, you know you're about to have a bad time of it. So if you're overbought here and the market's still going higher and you're hitting lower lows like you're doing here, and you're still going higher, then it means you're at risk. And we knew we were at risk. We've been talking about this for some time. But when you get to that like 11 on an hourly, what you always want to do with these is just take a step back and go, okay, what's an 11 on an hourly do for me? And then you drop this down here and you can see very clearly what an 11 on an hourly will do for you. It'll get you to a level that you really want to pay attention to, right? And because if you look at it, well, we do tend to bounce around here. And there's a couple reasons why we could bounce. And what's really interesting is somebody noted, a gentleman at Sentiment Trader noted, and I'll show you what he posted, that we're very similar to something that happened in 95. And I agree with that. For a long time, I've been saying this reminds me so much of when I traded in 95. I think, gosh, I guess I was 21, 22 at the time. Wow. Anyway, if we take a look here, yeah, that's crazy. Gosh, I've been trading 25 years. Anyway, if you take a look at this, you can just see that you're starting to slay. So can you go lower? Yes, you can. If we clean off my levels and we just take a step back and we look at the simplest of indicators, a 12, a 22, and a 55, we can see the consolidation around the 12, the 22, the break, and the 55. We don't want to break a 55. Why is that? That is a level of institutional support. How I look at the market before we go any further is this. I look at the market and say, okay, a 12 is, do I want to do a swing trade in that index? Remember, everything that I look at is top down. For those that are new here and unaware of top down, it basically means sector, stock, yes, but index. So it always starts there. Index, sector, stock. Okay, that's how I look at the market. So I want to see what that index is doing, then the sector, then the stock, and you'll see that today when I go through this trading, and you'll see what we bought today in the community and what we sold today in the community. But overall, you want to watch this and you want to pay attention to it. Now, the important thing about this is it over? Here's where I always run into an issue as a trader. You never know, but there's some signs already that, yeah, you probably are going to sell down a little more, but I do think that there's eventually a bounce out there. And that and a bowl of soup gets you a bowl of soup. And I'm sure you're going to drop in the comments on that one and tell me, thanks, Rocky. But let's go through this and just look at what happened today. So these are all the sectors that I watch. I don't even have the home builders in here because it's a sector, but it's not really a major one. As far as on a percentage basis, market capitalization, I just keep the big dogs. I guess I could put it in here. Mark it down if you want me to throw that one in here as well. But where'd the money go? To the Utes, 2 Utes, and then they bought some healthcare, and then they went from there. But it was pretty orderly. They're getting out of tech. We know why they're getting out of tech, or you should, and you will by the end of this video. I'm going to cover it in a moment. Here's the important part of all of this. Where'd they go? They got out and they bought Utes, 2 Utes. So what does that mean for us? This is where people get whipsawed. They will go out there and they'll go, oh, I'm just going to start buying healthcare. And they'll go buy the healthcare names. And then all of a sudden they're in the healthcare names. And then you know what happens? All of a sudden they start re-inflating the re-risk trade. If they do that, and then what happens? You're long Procter & Gamble and wondering why everybody's getting out of the market. There's nothing wrong with this. In my experience in doing these trades, this has never worked for me. I have never really been the guy that can time when to do the staples and when not to do the staples, and by staples, the XLP. If I wanted to do this, I think the easiest way to do this hedge, and you can take my advice or don't, it's just an opinion, it's just information. I would look at this and say, just buy XLP. If you truly wanted to hedge and you're just looking at it from a hedging standpoint, I would just buy XLP or I would buy the XLV and I would do it that way and I would be done with it. And you get what you get out of it. Maybe you get some basis points, maybe you don't. But getting out of those particular names the day that it corrects and you want to be in tech, it can be a pickle and you don't want to put yourself in that position. Now that's my 2 cents, but let's take a look at some things before we go a little further. So you can see the break right here on XLK and we broke the 55. So what does that mean when we break the 55? That means we lost institutional support. Okay, again, so why are you saying that we should be looking at getting involved here? Not yet. But I do think that there's some really telltale signs here, and I'll walk you through it. So what I always look for is not where we are, but where are we going? So what does this look like in a week? And we don't know what it's going to look like in an hour, less than a week, but you have to come up with a kind of a game plan. So I'll walk you through how I'm looking at this, and then please put your comments in below. But I'll start here. So the very first thing that we would notice is that you rally and then you fall apart. And then you rally and then you fall apart. And this is because you have buyers in the market, right? And then when you don't have buyers, you have a problem. All right, stay with me because this is really important. All right, so you have index and then you have sector and then you have stock. And then on top of that, you have macro. And let me hit this again. And again, just make sure you get in the habit of doing this. Then you have macro, fundamental, and technical. Okay, so again and again, and you're familiar with this, the stool. I'm not going to bring out the stool for time's sake, but this is how I view it. These are the 3 pillars of the market. That's why Goldman Sachs, Morgan Stanley's, all these firms, they have economists. If they didn't think economists did anything, they wouldn't spend the money. So you need to learn macro, fundamental, and technical. You need to learn that, and you need to look at the world from top down, not just bottom up. Okay, because you want to look at where the inflows are going, and the only way to do, what, who, when, on the stool is to understand index, sector, stock. That makes sense, right? All right. So if you understand that, you want to find out where the money's going. So in order to understand where the money's going, you have to think about, well, who are the buyers? Well, corporations buy their own stock, institutions buy stock, retail buys stock, and smart money, dumb money, right? We show that a lot. But you also have corporations and buyback. So you have these 3 subsets that essentially rule everything around you. All right. And these all interconnect with each other, and it's really this flow, and everybody says efficient market theory. In 25 years, there's never been anything efficient about the market ever that I have seen. I just want to point something, the last week of the blackout period. So I just walked through that we have buyers, and we have those buyers, and they are corporate buyers, they are institutional buyers, and they are retail buyers. And I did do the smart money, dumb money the other day, and we know that retail's pretty maxed out, right? And we know that institutions are starting to buy, but I guess they went out to lunch today. And we'll talk about why this dropped and what a hyperscaler is. And you do need to know this. You need to be aware of it. But what we're going to see here is this. As you're doing this, you need the big dogs. Retail can't keep the market up. Institutions can and corporations can. So if you start to see this drop right in here, that drop correlates directly with the last blackout window. And the lift of that correlates with when the window ended. You're running in and you're setting up for next week, not this week, next week. After all these earnings are out, you're setting up for the corporate buyback window. And that's going to start next week. And that's really important to get because corporations are going to start being able to buy their own stock. And that takes supply out of the market. It doesn't have to be your stock that they're buying back, but it takes supply out of the market. And therefore, the market will have a bid to it. That's really important to understand. Now, if you got that part of it, let's go to the next part. This is pretty fascinating stuff. And if you take a look at NVIDIA and what happened today, that you broke the 55. And the last time that you broke the 55, this is earnings, and then here's earnings as well. Well, this is the kind of stuff that I do. And people say, you need a hobby, but my hobby's trading. All right, so there we broke the 55, and there's 41 days out from where you broke the 55, right? Okay, we broke the 55 today, 41 days. You broke the 55 here, and that was the low. 41 days after earnings. 41 days after earnings, you broke the 55. I don't believe in coincidences like that. So I would watch this. Do I think that you're going to miraculously lift tomorrow because of that? No. Do I think that everything that counts out 41 days that happens to match works? No. Statistically speaking, you need 30 data points for that to even be statistically significant. What I'm saying is that right now, corporate buybacks are driving this market. That's the thing you should take away from this. So when we know that we go into the next blackout period, we know that we're going to go through this. We just went through the blackout period, right? And now we're going to come out of it. I think that's a very important distinction. And based upon that, I would start watching this stuff and start saying to myself, okay, I understand. And believe me, I was one of the guys that was shorting this today. As on the short term, I do have a long-term position in it. And looking at this and going, how much lower are we going to go? And I don't know that we're going much lower. I mean, I'm starting to have a positive divergence right here already. So I don't know. I don't know how much lower this is going to go. I don't know that we're going to continue to break. If we could, you could get a 90 handle on this. To think that you can't do that is a huge mistake. And I do have a lot to go over, but I want to show you how you should be thinking about this. I was talking to somebody about this today, and I said, we don't see any panic. And he's like, well, the VIX is up 20%. Okay, and that's not panic. So if you look at where were these levels marked that created panic before? Like, you look at the past to determine what the future is going to be, not because it's going to work the same way, but so you have a baseline to work off of. So if I was just wanted a baseline, I go, well, where did we peak and drop before? And then you would go and look at your trusty graph and say to yourself, well, I'm glad I did this. You would get up to here and you'd say, well, that 21 and then 21 here in October. And then you would go here and go April 19th. Okay, April 19th and November 1st. I wonder if there are dates that we should look at. And then you'd come here and go, oh, April 19th. Oh, November 1st. What do you think we should be looking for on the VIX before we even think that we're near? It doesn't mean it has to happen, but wouldn't that be a great guide for us to set a level here and set an alert and go, hey, I really want to know when that's going to happen? Is it prudent to be buying stocks with the VIX breaking out, hitting new highs? I mean, that's something that only you can answer for yourself if you think that's prudent or not, right? Okay, let's keep going. So if we jump into all of this red, you're going to see certain names in here that are red, right? You have Tesla, obviously dumpster fire of the day. I mean, it was really bad last night, and I went through that ad nauseum. But over here, you're going to see some things. Google, Microsoft, Meta, Oracle. These names, crowds just did dumpster fire onto itself. But when you start looking at Google, Microsoft, the earnings, Meta, why is Meta down? Why is Microsoft down and Google? Why are these names getting destroyed? Why is Amazon down? Why is Apple down? Why is AVGO down? These are called hyperscalers, not AVGO. But these are the names that are buying all the CapEx. So if you take the big dogs that are in AI, it is 38% of the S&P 500's capital expenditures, 38% of it. So you have Meta, Google, Microsoft, the big dogs, Apple, all competing, Amazon, with the data centers and what's going into a data center and the super secret chips. But don't worry, Tesla's going to fix that. Try not to laugh. But when you start to connect all this, and then Google gets a simple question last night, and this is why Google dropped. We can go back to this and you'll remember this. But why did Google drop after hours? And again, fundamental research. When you understand what you're looking for after hours, you can kill it. So, I mean, you can just see when they said the wrong thing. You can literally see it on the chart after hours. Hopefully you can see that. But what happened here? When they were asked a question, well, you're putting billions into AI. And when you're putting this billions into AI, what's happening? Oh, well, our ad revenue's going up. Is that it? Yeah, that's it. That's all that's going on. And then it was just like womp womp, and that was the end of it. All right. It's really important to understand that they don't have any real revenue generation from what they're doing yet. Now, the flip side of that, and I'm not going to get into it tonight, but if you want, I'm going to explain to you why they don't care that they're not making revenue or not. I'll get into that later. But if you're interested, I'll cover it on Saturday. But Google's not going to care. Meta's not going to care. Microsoft's not going to care that they're not generating massive revenue off of it right now. The market's going to care, and it may punish their stocks, but this is the first wave. And you have to understand that this stuff is going to go through waves. And that's really important to get because this reminds me a lot of 95. And someone posted that earlier today. To start with, I just want to give credit where credit is due. So I've been talking about 1995 for some time now and the parallels between cutting rates and increased productivity. And there's a lot of parallels here. I'm going to show you some of them. But Jason put this out, and Jason's actually associated with Sediment Trader. You'll see me show a lot of their stuff. I have no affiliation with them whatsoever, but he does put out a lot of good stuff for free. If you're looking to follow somebody, you might want to follow him. It's all objective information. You do what you want with it. But NASDAQ Composite is down more than 3%, but there's still more volume flowing into advancing stocks than declining ones. This is really important. I'm going to show you this in a second. Over the past 40 years, more than 10,000 sessions, this has only happened one other time. And then everyone always tells me I'm pointing out these things. But this is true. Now, he's got these two pieces here. I'm going to show you that, and then I want to show you what we look like right now. Now, here's the article, and I found this fascinating, but this is July 19th, 1995. Only a day after posting several records, the stock market fell sharply yesterday in its biggest decline in nearly 9 weeks. The drop is attributed to some traders' concern about technology stocks, especially Microsoft, 1995. Could you imagine? The issues have been high flyers and have outpaced the overall market to reach record levels, but they now could be rising higher than their earnings. I wonder where we heard this before. The Dow Jones Industrial Average plummeted 51 points only 50 minutes after the start of trading. 51 points. Circuit breakers. Rules on the New York Stock Exchange designed to slow high-speed computers. There they are again with those internets and calm turbulent markets. Okay, now this is the graph that he posted, and I just want to go through this. Again, it's Sediment Trader. This is not mine, but I just want to give credit where credit is due. Look at the rate of change. Right here, okay? And then you can see that you're past the 3 handle, and then you can see that you're up volume ratio. So think of this as an AD line, and look at where you're at right now. And then look at this drop that you're seeing right now in the market. Now imagine for a second, and you're gonna have to use your imagination, and we're just gonna have to go on it, that you don't have any of this up here. And all you have is from here over, and all you can see is this rally and that drop. Now we already know where we are in the VIX. We already know where we are with the corporate buybacks. But take a look at this, and I'm just going to pull this out to 2020 and then just zoom out on it. And this is rate of change, and this is the AD line. And please comment below if someone knows how I can put some of these up onto TradingView so you guys can grab these and just save these layouts yourself. Let me know. I'm more than happy to share them with you. I have literally hundreds of layouts. Also, if someone could comment and let me know, do you know if it's possible to set up sectors create my own sectors? I have my own sectors. I don't have them in TradingView. I'm more than happy to share them if there's a way for me to do that. So let me know that too. But let's get to this. So here we are on the Qs, and they're saying there's only one other time when this has happened. So what we're going to do is we're going to go take a look at this particular time, and we compare it to what just happened. And what he's saying, and I understand where he's going with this, and he's right. So you're falling off a cliff. The sky is falling. The sky is falling. We've got this island reversal. This is actually an island reversal or an island gap continuation. It's not really a reversal. It's just me speaking, but it's not. It's like, here's the island, and then you have a continuation. So it's not groovy. Like it shouldn't make you feel warm and fuzzy, right? So what do we have here? Okay, so we have the rate of change that is well right around the same area. And at the same time, this is your AD line. Your AD line's going up. As the market's dropping, your AD line is actually going higher. So the question then begs, well, what does that mean? Well, that means eventually this will catch. You're not going to fall apart if your AD line's doing that. And this falls right back, and you can just rewind that one piece of it. But this goes back to this. Do you remember? You might remember this from 2 weeks ago. Here's the RSP, and what we're going to do is drop that into a line chart, and then I'm just going to go to a bear, and then we're going to go here to the SPY. And do you remember what happened on July 11th? And you might not, but that's why we're going to go through it. So on July 11th, you won't go back that far. We'll go to a 5, and we'll get rid of the pre and the post. Then now let's rock and roll. All right. So if we go to the 11th, we noticed that we had a change, and that change was the CPI. PCE is Friday. Remember that. So what do we have here? We had a change. And we talked about this. We actually talked about this 2 days ago. You can see how all these videos are linked together, hopefully. And what happened here? Why is this so important? Because RSP took over, equal weight took over for the market cap weight. And RSP was winning for the first time. And what does this, in a long time, so what does this mean? Well, once they were selling these, the market weight right here, the equal weight caught up on the sell side. So why did that happen? And then that takes us back to this chart that we just went over about, I think we went over this on Saturday. We actually went through it before. We've been going over this for at least a week, especially if you're in the community. I think you're sick of me showing it. But this breaks down stocks below the 5-day, the 20-day, the 50-day, and the 200-day. And I said every single time you get to this level, you have a pullback. And all of them were at that level. So we're setting up for a, quote, pullback. People need to understand that there is going to be more volatility. And I'm going to have to break out the skew chart. I can just feel it. But you have to understand, you're going to go through way more volatility like you did in the late and mid 90s than you're used to. People are not going to be used to it. And that's because of margin interest, and we've gone through that. I'll get into it on Saturday more, but you need to understand this going into tomorrow so you understand why this is happening. Every stock, when they are above these percentages here, it just leads to, I better lock this in. And we know that we need a VIX with at least a 2 handle because we've seen that before, and we know we have the buying coming up. All right, stay with me. So now we know what to look for on Friday. Okay, we know we should probably be watching this on Friday, correct? PCE Friday. We know what they're selling, and we know what the hyperscalers are, and we realize that they're not going to fix this problem. You'll note that I'm not saying let's look at Google, Meta, and Microsoft. You're going to have to start branching out. Now, tonight, CMG came out with earnings. CMG had a really good call, okay? And you're starting to see this. Individual names are starting to break out. We're starting to see less correlation. You're going to start entering a period of time, in my opinion, that is a stock picker's mark. This was actually a decent call. It was actually up to 60 after hours, and we actually traded this and did quite well with it. Now, the important thing that I'm getting at with this particular trade that I want you to wrap your mind around, this was something that I actually bought calls on, and then I actually shorted right here. And I'm going to show you this because you're going to say, no, you didn't, because I'm not saying I shorted at the high. But here's a timestamp from the room. Now, I have two trades I'm going to walk through. I have a DPST trade I need to walk through so you guys can understand that I'm not going to have time tonight, but I plan on doing that one possibly for tomorrow. It was a really good trade, very easy for you guys to walk through. And then this is a little more complex. Maybe I'll lay it out on a Saturday. But CMG 55 calls, I paid $1.25 for. You can see the timestamp up here. And then when it got right up into this range, I'm shorting the stock, okay? And then it's real simple. I'm watching that lift, and then right in here, I'm actually, when it got to 60, I'm actually selling into this bar. Then I'm buying more when it starts getting weaker, and then I add it here. So what that does for me is it gives me a hedge. And then as the call goes on, if they say something dumb, and they said something dumb, and then all of a sudden the stock dropped back to that breakout. Now, I have the 55 calls on, and I sold half of this. So what this allowed me to do is, I'm telling you, I'm shorting the stock against the 55 calls, locking in a $5 gain, the $1 calls. Thank you very much. I still have half not hedged. So I left half off, but the calls were only $1.25. So I lock in 5. So my entire trade is free at this point. Now, what we do next is this. Once we're up here, we're hedged. So I paid for my trade. See, I don't need to make the most on every trade, guys. I need to be consistent. I need to make money, as much money as possible in every trade and be consistent, but I don't need to make the most. Start selling down. And my goal was, if I got back to 55, I'm net on it. I would net $5. It would pay for more than the entire trade on 50%. So it was basically giving me free calls. And so they say something silly, gross margins, blah, 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 burritos are too expensive, and the stock drops back down all the way to the breakout bar. Into this, I start trimming. Into that, I start trimming. So I start covering, and I made $7 on that whole trade. So now I've made $7 after hours on 50% of the trade, or $3.50 on the full trade, however you want to look at it, and I paid $1 for the option. So no matter what happens, I'm netting 2. Period. If this is of interest, this is somewhat more advanced, but if this kind of concept is of interest, please let me know. I think it would be, because I see so many people after hours going, oh, I really wish my options would open. You don't need them to open. You just need to know how to hedge your option positions. And then once you learn how to do this, it's simple. It's simple for me because of the amount of time I've been trading, and I was a registered options principal for 9 years. But this is simple stuff that I can walk people through. Let me know. I'll do one of those, like the price stock action videos that I'll link at the end of this. I'll walk through this so that you guys can learn how to do this as well. Just let me know. I don't want to go over things that you think are either too advanced or you find boring. Now, I've been going through this chart with you guys for at least a month now. I'm going to just bring it back. So when you see the volatility in the market, your response is going to be, oh, the skew changed. And you're going to be saying, well, what are we going through? Oh, we're going through QE. What does that mean? Fed incentivizing long assets, steep skew to hedge. So that means people need to buy puts. Oh, okay. That's why we're seeing the volatility all over the place. And it's very different than what you saw in 2020 when the volatility was dropping. And you're going to say to your friends, and when they say the market's crashing, or when I put out one of those clickbait titles, you're going to say the market's not crashing. It's the skew, Rocky. And that's going to be the end of it. Please remember that the volatility is going to increase. Now, there were a lot of great trades today, from Tesla to Google to Meta on the short side, and there's a lot of lessons I can go through. But the one thing that I want to get through to everybody is no place was safe. There was literally no safe haven today. And people need to get that. Like, you could look at this from a zero line perspective and go, well, it looks like some things were up. Yep, if you want to go by the solar names and the EMPH and the squeezes, yeah, you could do some things today. But really, at the end of the day, there wasn't a lot. I like this chart a lot. What it shows me is it just shows me that there's weakness. So what are you supposed to do with everything that we just went over? You're supposed to understand that really what you need is you need the corporate buybacks. So if you're saying to yourself, as I get asked a lot, thank you for everything, now what do we do? What you do is understand that you're not really going to go anywhere or have a bid on this market to corporate buybacks. And that ties in perfectly with PCE on Friday, which will then, of course, cover pre-market live when it comes out, so we have something to trade. I expect that to act just July 11th, and we'll point out the names again that we're doing. But understand that that's where this is all going. There's a lot in this video. You might want to watch it a couple times. That's it.